Thank you everyone for joining the call. Woo, woo. Don Getling here. Gino's on vacation. Yes, we let him go on vacation occasionally. Yeah, he's actually he didn't really have a choice, because if you didn't know, Bill, his wife and daughter are on the national basically they call it dragon boating, which is like an outrigger canoe with multiple people paddling. They're on the national team and they're at the world championships in Thailand right now.
Wow.
So yeah, they've been winning golds. They went to Pan America Games, won 8 golds. I mean, they're legit, so we know that.
What
Gino
is a dragon canoe?
What's that?
What's a dragon canoe?
Dragon boat. I'm sure eventually Sonia will pop one up for us so you can see what it is, or a picture of Nella. She'll probably pull it from Facebook, and she's like ripped.
She's a beast.
We don't even give Gino, like we looked up the odds, Nella versus Gino. Yeah, Vegas gave Gino no odds. Look at these. Yeah, that's dragon boating there. They're just, and she trains every single day. So that's where Gino is at. So you got Don and the Bill Show. So if you guys don't know Bill, most of you do, and that's why you're on the call, and good for you. And I love seeing all our friends on the call. Every week we do this for you. Remember, this call is for you. We call it More Momentum for a reason. You go to the Momentum Builder event in February to get your butt kicked and ready to be prepared for your earnings season. That's why we do it in February, because your earnings season is there's the team. There's Nella right in the middle there. Look at her. She's all red. Look at her. Are you kidding me? that's Nella. That's freaking Gino's wife. Yeah, she makes all the rules. Funny. She wears the pants.
We all knew that.
Right. We all knew that, exactly. So Bill's been part of mine and Gino's life and the industry for. When did you start in the industry, Bill? I mean, I know you might not want to say.
No, I started out of college. So out of college, I moved from Ohio to California to run a real estate firm. I was recruited in 1978 to come out and run American Realty, and they owned Winchester Mortgage. So that was my initial, became a broker and ran their real estate company for about a year and a half, 2 years, and started First Franklin in 80.
And if you guys don't know First Franklin, Bill was the originator of really Alt-A. There was no Alt-A. There was cookie cutter type loans, but there's no way if you had great credit, had good income, but just didn't have the down, you couldn't get into a home. Bill created that. And I used, that was my go-to. If I didn't have something that fit in the box, I went to First Franklin, and it was done right. So I'll let Bill talk a little bit, because his Alt-A was not what it became that decimated our industry. It was well thought out, and you qualified with good credit, and you qualified with income, and then it got bastardized big time, and it just went to shit after that.
Actually, it was pretty funny too, because when I started in the business, it was hard money. Interest rates were 20, right? Interest rates go from 79. It's a little bit like today, right? From 1979 to 1980, 81, interest rates go up 10%. So we go from 9.5 to almost 20, 18s. And the world just was shocked. So that's when I started my business.
Yeah. And it was, like you said, it was game changing. I got my first loan from that, because like you, believe it or not, Bill, I got into the mortgage. Like nobody grows up going, I'm going to be a loan officer. Like maybe 1 in a million, because their parents did good at it and they decide they're going to do it. But in most cases, not on the check box. You don't check that box in high school or when you're in college. I got into it accidentally because a mortgage company decided to try recruiting college people. And they said, let's try getting a college person. So they decided to choose 1 out of 200 interviews at Cal State Northridge. And I had a finance degree at that time, was graduating. And I went in the interview just to get practice. And you'll get a kick out of this. Go, so how did I choose it? And how they choose me? I went through it, and everybody asked, so, what kind of income you want to make? And right then, when I was graduating in 87, it was 34 to 40 grand, which when you go from college making basically nothing, you're like, whoo, I'll take it. But they asked me how much you want to make. And I said, how much can I make? And they said, as much as you want. I'm like, well, then 100 grand. And they're like, you can make that. I'm like, okay, I'm in. And then I asked them, how come they chose me? same story. They're like, everybody else said 40 grand, 35, 40 grand. You said 100 grand. It's a money motivated job. So they hired me, and I haven't looked back since. So like you, I've been in it for a long time. We've seen cycles, and that's why we brought Bill on. Is Bill has been, he's run multiple companies. He's one of mine and Gino's hardcore mentors. Just people ask, and it was really funny. At our current company, Bill, they asked, how did you and Gino learn all that you learned? Is there somebody that we can bring to our event, our leadership council, to teach what you and Gino know? And I'm like, no, not really. It's, you learn it over time with having good mentors. Like Gino and I have been tied with you in depth, and Bill and the other Bill, and so many mentors. So we've had mentors, and we've screwed up a lot. Like we have made a lot of mistakes, but we learn from them and then become better and better. But you got to be fearless. And that's how we became better. You know our story probably better than most. I don't know what do you feel is mine and Gino's success direction, so that those on the call go, here's what you saw, because you guided us a lot.
Yeah, I think passion and grit. Right.
Grit is one of my favorite words.
Passion. If you don't love the mortgage business, then you have no business being in it, right? Because it's a complex, it's a very difficult ride. But I think most people who are in it love real estate. They love working with other people. They love their teams, right? It's a cultural thing. I think that part, and being passionate about what housing can do, is important. And then grit, right? Don't quit. You guys don't quit, and you try to market things, right? You try different. I mean, you look, I sort of shouted out yesterday when I saw, you got a new CEO coming into Rocket, which means there's freaking problems in the Rocket launch.
Right.
And the second piece was, now we're going to start hiring loan officers, and we're going to go out in the communities. I said, it's interesting. I just sort of put it, when the lion roars, right, in the jungle, everybody shivers. So I think there's messages in that. And I think what you guys have proven over time, and really all the folks on here, I mean, all my friends, all you all, from Katrina to Craig to Cassie to Chris, Razak, I mean, all of us love what we do, right? We do. And that's why I think if you love that and you're passionate about it, you figure it out and you don't quit. And this is a time, right? This is quitting time. This is like, I really don't understand what business I'm in. I mean, I counsel lots of companies today, and owners and different folks, right? And everybody's suffering, and things are tough, right? And then they just got tougher, right? I don't think this is probably one of the tougher slogs that we're going to see in mortgage that's not caused by credit crisis.
Right. Yeah, and it's lasted longer than any of us expected. I mean, there's some experts that did.
It's not very long, but it feels like it's really long.
Well, I think why it feels longer is everybody felt that it wasn't gonna last that long. Everybody felt that the inflation would cool, rates would go down, and it'd stimulate the economy, give us refis and all that stuff. And we're all hoping that was going to happen. Nothing gets Barry. He's always been on fire. But this is a weird. You and I were talking about before this. This is weird. This is not a normal economy, normal industry, normal numbers. Yeah. Every time we get some tailwinds and think, here we go, we get headwinds. Just like, I mean, we thought we were going to do better with inflation numbers were incredible this last time, lowered inflation by a full %. And then we get somebody that says, oh, your credit rating went from AAA to AA, which has happened before, by the way. And now the market tanks because of it, because everybody's fearful. Am I right?
Yeah, they're fearful anyway. People are looking for another shoe to hit you in the nose. So no matter what, right? The market is searching for, I think, triggers, and every time they see a trigger, they're going to hit you with it. And that's sort of why the stock market sort of traded 33.5, 35-ish, and it keeps going up and down. That's why interest rates keep trading in the same range. I mean, you think about it, I mean, we have been inverted for so long, and for housing, we've been in a recession. But it's interesting, how can you call it recessionary when home prices are going up and, there's no
And
inventory, so
job
they're going to
market is
continue to
tight.
go up. Job market's very tight.
Mhm.
This is Fed induced to some extent because that's what we have to stop inflation or slow it down, or you are back to Volcker 1982, watching prime rate go, through the roof. And so I think we've learned a lot. But for housing, I think we've figured out we're in a purchase market and yet there's no inventory. So what do we do?
So on that note, I'd love to get your insights because you've been around the block like me. For myself and our team, and many of them are on this call. Thank you guys. I love that you guys are leaning in like we are. It's weird, Bill, because we don't quit. We have grit, as you said. And it's funny, Gino said after we went through and the market started slowing down, he's like, "Are we going to do this again?" I'm like, "Hell yes." And he's like, "Really?" I'm like, "Yeah." He goes, "Why?" I go, "Because every time we do better, because we get smarter, we're more experienced, and we have better people behind us because we don't choose anything less. Now we only work with A players. We only work with great salespeople that we like working with. We won't work with assholes, sorry for lack of a better term, but we just won't, because that was our transformation of liking this industry and being more successful, as we work with people we really love going to work with every day and love supporting. So we're actually excited about this market because it's created opportunities we haven't had in quite some time. For us as regional managers, trying to hire somebody before was impossible. Why were they going to leave when they're killing it? Now we're finding great loan officers, sales professionals that need to find a home that's going to give them at-bat support, product, marketing, everything they need to survive this market. And then when we get the other side of it, we are going to kill it. But now it's open opportunities for us to get great loan officers and real estate agents. They wouldn't take a call before. They're just as hungry, and now they'll take a call and go in front of us because they're like, "What do you got for us?" Well, we're leaning in and giving them options and strategies to help them become successful and get the other side. So we're actually excited about this market.
Yeah, me too. It's like moving day in golf. It's the Saturday. It's not the first 2 days. It's the Saturday and the Sunday. So when you look at, I think when I started, when interest rates went way up, the market sort of shut down. And so you had to manufacture transactions, right? Because some just have to get done. So whether you're buying, selling, or whatever you're flipping or whatever you're doing, what we found when we started our business in the initial days was that I became the person that could actually put deals together, find income, and make transactions happen. And I think you're sort of leaning on those skills today. And the challenge, I think the challenge in the market, and is overall, and it's sort of interesting because agency rates have gone way up. I think non-agencies become somewhat non-existent because the banks have retreated. And the banks, and I've always said this to you guys, if you think about mortgage in general, non-agency, which is, let's say, has been bank lending, you have no conduits, you have no Countrywide REIT, you have no IndyMac, you have no Prudential, you have no GMAC RFC, basically you have no Redwood Trust or anybody, right? So there is no conduit for jumbo. There's probably MaxX, a couple of places like that are trying, and now you've got the banks, Silicon Valley, and all the problems with PacWest and the others, right, that they've experienced. So the regional banks have pulled. Wells has pulled back. Chase really hates brokering anyway. They really don't like real estate. Most banks don't. And so and the edge, as I've told you guys when we started back at Skyline, was that they've got this 3.5% cushion that the government gave them coming out of 06, 07, 08. So their cost was 0. Prime was 3.5. They make 3.5 points to open the doors every morning. So they could price jumbo loans 100 basis points under what the market would do. Well, that's all gone away. right? Not only have they gone away, right? So you can maybe go direct to a bank or go through, I mean, you can't go through really through private banking and get any big benefit. So I think all of that is normalized. And then you've got the non-QM rates coming down, becoming more real. So you're in this, what I would say, product time. You need an equity share product, I think, to really make the market, to appeal to everyone in the market. So because some people just can't afford the payment, but have a lot of equity. And then on the other side, you need to figure out how to power purchase. And the challenge with it is that income, and this is still, I've been doing it now for 40 years. The government never changes its income rules, and it rarely changes its asset rules. So here we sit, right, in an industry that needs to change. So you see things like asset depletion, bank statements, you get DSCR. All these things aren't new. It's just a different phraseology stuck into non-QM, right? Because you have to do ATR calculations in order to make sure that the non-QM loans don't have a huge toxic tail to investors. And that makes it a little harder.
Well, Mike was just asking about that you're mentioning non-QM, and he's, it's weird that now non-QM and hard money are in the same space.
Same.
Their terms are very similar. I mean, we're actually losing deals to hard money.
Yeah, I started First Franklin in hard money. Well, if rates are going to be high and I don't qualify and I want to buy, you're sort of there, right? And seconds, God help us with seconds. Hey, you want to take equity out? Yeah. How about a 10 to 12% second? No, I don't really want it that bad, right? So how do we originate more loans and meet the needs of the customer base in this environment? It's that simple.
So that's the challenge we're all having is you're having to know guidelines from all your internal ones, because I know luckily our company has 300 some odd products, and then we have to know 9 to 12 non-QM banks, and then 8 hard money lenders. You really have to know every gambit to find a way to get a borrower into a home right now, because other than that, it's hard to compete with the banks right now. The banks.
Yeah, it's always going to be hard. It's hard and it's not. Heck, I used to pick up most of my rejects from the banks, right? And just do their loans. They're not the smartest tools in the shed. They just have
very
money.
Limited in their box, right?
Yeah, their boxes are all like this, right? And I think, so my view of it is that you can't, and I always simplify it, and you guys have probably heard it before, but we have one loan type, a 30-year fixed rate loan, and we have 500 sets of guidelines that we have to memorize or figure out. And some underwriter's got to be the hockey goalie, what I've used to call it. Why don't we have then one product that does 500 things? That should be simple. All you have to do is take agency, non-QM, and create a set of guides. That's what I do. So what I'm trying to do is go back. Now, how hard is that? That's pretty freaking hard, because I've got to go to investors on the other side and have them buy off on my guidelines, right? And that's what you do. Because if you don't, you are not going to solve this by trying to be the master of 900 different products, right? It's going to be too hard. Plus, you're going to broker half of them out, right? Exactly. You won't make any money. You won't make any money at it. And then you lose control, blah, 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 right? So I think you're in, I feel like I'm back in the sweet spot, because nobody really has ever created a product the way that I know, right? And then I've probably in the last 90 days spoken to 50 investors on the other side. And this could be anybody from Athene and Apollo, who own NewFi, to KKR that owns, eResi, to the Veris people, to Atlas SP that just spun out of Credit Suisse, to Bain, to Warburg Pincus, to, just line them up, right? And I've talked to all these investors. And what's interesting and I'll say it this way, is that they all want to do loans. They don't really care. Agency, they don't even know. They need a little bit of yield, and they believe, and they want them on single family loans in America. So why is this not fit? Well, there's all the noise. Basically what I tell them is the same thing that I tell investors everywhere. The mortgage business is owned by the federal government in America. So if you want to do non-agency loans or non-QM or anything else, you have to cannibalize agency, which means you've got to be better in underwriting, quicker, faster, maybe not the best rate, but you can get your customer on, and you know how to do it. And it gives you
simplify it.
Answer. And then you guys, I watch you guys. I mean, every company that I talk with is trying to do an FHA loan or a Freddie Mac loan with a bond loan behind it. I mean, it's like the freaking nightmare of America. It's a lot of work. And it's a lot of work. Every company loses money doing it. Yep. Customer might like it, makes sense to them. Yeah, I get a free second or whatever I get, but it's a nightmare. So I think the answer, part of the purchase answer is doing no MI, whether you're going to 90, 95, or 100, the market has to get used to it, but you've got to be able to create high LTV answers for first-time home buyers and others, because consumers need leverage to buy homes. I mean, now, the moment I say this, right, we've got like, I don't know what percentage of the market is cash. Well, look, that's probably the biggest anomaly that I think I've ever seen. That and flipping houses. Those two things are probably unique to this deal, right? These last 5 years. Now you've got no inventory as a result. Well, where'd all the inventory go? Goes to flippers, goes to non-owner occupied, investors. You had all these people. DSCR is a product. DSCR is a way to underwrite income. It's not even a product, right? So I think when we think this through, so I'm going to get back on my horse, so I'm trying to create mortgage products that assist, all of you all on this phone and on the podcast. It allows us to actually do more loans, but it somewhat expands the breadth and simplifies the income analysis so that when a consumer actually wants to buy a house and you want to sell it to them and the realtor understands it, that you understand how to put together a deal. And I know when I invented the 100 and 80-20, the hardest part of that, and I invented it with Freddie Mac. Wasn't like, hey, right? We started, we knew, no. And so we started it knowing that, well, realtors had no idea how to write the contract. How do you write a contract? I mean, you're putting no money down. What do you do with the deposit? I mean, how do you write it? And if I'm competing against a cash offer, the first thing that everybody says is this buyer, isn't quite as qualified as my buyer, so sell it to me. And so we had to develop strategies and ways to help realtors, our partners, understand how this actually helps them sell another house. It puts the seller more in control because the buyer really needs the house, has to have the house. They want the house.
I always say that an investor can go anywhere, where somebody who loves that home will do anything to get that home.
Yeah. So I think we just have to condense all these guidelines and rules to help you, so you don't have to be the master of some matrix of this company does this company does that, and you can't keep signing up investors. Guys, we will fund these loans and we will fuck them up, and we won't be able to sell them. It's too complex.
Well, the complexity also makes it harder for a company to actually sell these loans and not have buybacks, because there's so many complexities between each of the investors. What I mean. So one investor is going to say, no, I don't like this. Well, the other 5 did, and we saw, we don't like this one thing.
And you guys know that the moment you roll out something new, what the first 100 loans don't fit the guideline. I mean, I don't care what the guideline is. The customer doesn't know what the guidelines are. They just come in with their little warts and everything else that they've got, and they present it to you. So you have to be able to make the exception, or you don't even have a product, right? And that just isn't the way the world was all about vanilla. So we are moving very fast the other way, and most people don't know. I'd say half the industry only knows refis, so they're dead.
That's true, and they're being sought out really hard right now.
And the other half is just getting used to higher rates. And how do I get somebody on, right? And no inventory, and the standard macro things that are affecting mortgage right now. Because I mean, the mortgage business, Don, was built. I mean, look, it's built on the backs of independent mortgage banks, like all of us and brokers, and it's owned by 3 government agencies: Fannie, Freddie, Ginnie, 2 that are GSEs, 1 that's Govy. But it's built on primary occupant, owner occupied, primary wage earner DTI, the whole thing. And that is not what we're seeing today.
No, not at all. Yeah.
I mean, look, even single family, that's why I keep saying the one thing that I'm trying to do with single family is give it a broader use. It's almost, because you're going to live and occupy it, you're going to rent it, ADU and roommates and everything else, you're going to work in it, and you're going to play in it, you're going to retire in it, right? So it's radically changed. So the government rules have not. So how do we help you, right? Take this, and if we're going to be at 80 to 90% purchase over the next 24 months, and we probably are. I mean, and maybe if rates do drop, you'll be at 70-30, right? So I think we just have to be ready to, how do we help people purchase homes? And if you're first-time home buyers, you got lots of issues. And if you're second move-up buyers, you got different issues. And then if you've got reverse and you've got lots of equity, what do I do? Issues. So you've got to have products and services that do that. And we don't.
Well, that's what you did back in the day, realistically, because, you know, right now, a lot of us out there are challenged because of the race to zero, just trying to get whatever business you can, low margins, nobody's making any money because of it. And then we're all challenged by, because we had such low rates for so long, no one could sell a higher rate until, like you're saying, Bill, correct me if I'm wrong, but when I sold First Franklin, it wasn't the best rate. It was, we have a way to get you into, I paid 7 3/4 on my first and 12 1/4 on the second or something like that. I was so happy to get into a home. Bottom line, it wasn't close to a Fannie Mae first, but it helped me get into a home. And right now, like you said, first time home buyers with affordability challenges, we need something for them to get into a home that's a little higher DTI due to their high FICO scores.
Look at the VVOE I-10 FHA product. I mean, if I go to most of America, if I go mid-section flyover states to a little bit in other markets where most of their volume, I'd say 50% of the volume today is a FHA loan with maybe a DPA behind it. Okay, so
yeah, the markets we're doing best on affordable markets for sure.
Yeah, if you're trying to do affordable, right, you've got to have solutions for affordable. The problem with the agencies is that affordable houses have to be condos, townhomes, co-ops, modular, and manufactured homes. That's the only way that a property is going to be affordable. You have to be outside the area, and you have to have, and it has to be probably newly constructed, because the cost of doing that is so much lower. Well, the agencies hate those products. Hate them. Everybody hates a condo association suddenly, right? And yet, you know, they're the lowest price. So how do you navigate? That's just property type.
Right.
Now you've got income, you've got credit, you've got asset, and then you've got, okay, how do I combine all of that into a product that fits? I remember I actually use it. Frank Raines, who used to be president of Fannie Mae, had a statement that when Fannie Mae was at its zenith, they had a statement around the company that said, we want to customize the commodity. What you think about it, we have a 30-year fixed rate loan, we all have it. How do you customize it? You have to create nuances in the guidelines so that when a consumer sees it, they see themselves. And whether you're a teacher, preacher, whether you have 5 other jobs, what we're seeing today is a very complex set of borrowers who've all been thrown out of their office to work from home, to get another job, to move something, so they don't have stable employment income. They don't have 2 years. Most of them don't even have a freaking base pay. Almost nobody has, guaranteed overtime or guaranteed bonus, right? They have. So now I've got 3 other jobs, and I can't count any of that income. So the answer has to be, and I see with Edgar, part of it's increasing the amortization to 40 years. And you could go to 40, what I said before at First Franklin, you could go to 46.5 years. And that's an IO. No principal reduction, but there's still some amortization. So if you have to have an amortized loan and not an IO in order to be, a QM loan, then you can, right? So I think you have to increase the amortization. You have to go to a higher loan to value, and you got to count income. And it's got to be easier than what the hell it is right now, right? Because it just fucking nightmare to try to get, if you're a consumer, and I almost hate to ask them for information, like how long have you been on your job, and where you're like ducking as you're asking them questions, and they're telling you the truth, basically saying, well, I actually make about $400 a month doing this, and I got 600 I got over here, and then my wife, she does this, and my kids live at the house, and they pay us like 400, and it's like, okay, oh my God. And you wonder why files sort of look, and then you go to the real problem in the industry, is that productivity is at an all-time low and cost to produce is at an all-time high, and all the businesses are getting, that too. Everybody's losing money, hand over fist.
We don't have units right now. There's not enough inventory. You don't have the
units, but we create high cost structures.
No, you've hated this. I've always said day one. You always say that. Oh my God.
Yeah, you got, like I've always said, I need an LO. And the funny thing about this is the LOs have not caused the cost problem. They're variable cost. Mm-hmm. And almost every LO is variable, and their costs are set by Dodd-Frank. And you can't change it by product. So where's the cost coming from?
Compliance.
All these teams, structures, LOAs, process. Look at all the things that we've had to add in compliance to just the way a loan works. And so what you've got is a cost to produce that's gone from $2,000 a loan in 2000 to $16,000 a loan. It's untenable. So and everybody complains about pricing. Well, no shit. Your pricing is going to be high because everybody's got to increase the prices to pay for the margin because the costs are so fat. It's like, oh my God. How are we going to do that? It's almost as bad as like when they say they're going to have electric cars, and I go, how the fuck is this going to happen? Right? We don't even have batteries that work. We don't have places to charge them. Why don't we really just say we want a hybrid for now? And everybody should get a hybrid, and then we work our way when we build the grid, and we know we have sustainable batteries, and we know we have those things.
And we know what to do with them.
Mortgage is the same way. When the government roars, stuff happens, right? And you sort of sit here and go, well, I'm going to tell you, you guys will be doing 50% of your volume away from agency really quickly.
A lot of it's happening now. If you talk to like Razak, who's on this phone, he did 2 out of 10 loans, were agency. Other than that,
that's why he's a top producer.
Right. Well, he had to adjust. You know, we have another LO who hasn't adjusted on this because he's refi and he does a lot of agency, and that's not there right now. There's none of that. And we don't even know when the refis, we were hoping they'd come back by now, but now we don't know
Not,
when it's coming back
well, I
because we
mean,
keep thinking rates are going to come down, but we don't know.
well,
That
maybe,
could be at the end of
and
the year,
I'll,
it gets a little better, maybe first
maybe,
quarter, but we don't know.
but if you, I mean, look, let's, like I said, equity sharing. So I've been working pretty hard on equity sharing. Why? Okay, come on. You guys were all with us at Finance. Some of you at Finance of America, we had reverse. What is reverse? Equity
Equity
sharing,
share. Sure.
right? No payment, equity sharing. If I asked you just off the top of your head and didn't call it equity sharing and said, if I could give you $100,000 of your equity and you didn't have to make a payment, how many would raise their hand? Almost everyone.
Everyone right now.
And then as we dig down into it, you might say, oh, well, that may be, I'm giving up too much or not. What I like about it is that if you have a lot of equity, there's two borrowers, right? There's the mass non-affluent, and then there's the affluent. The affluent who doesn't have income needs equity sharing, right? They do. So if I need $100,000 or $200,000, I can't afford a payment. So it becomes a balance sheet decision. And remember, agency lending has, you can't use compensating factors. The house has to stand on its own, and it's DTI driven. It's an income business, right? We are in the asset business and the income business. And so you've got to have products that enable you to do both. I, as an originator, just want to make sure I've got an option for a consumer who's got a big balance sheet with a big asset and they don't have any income or don't qualify income wise, because I don't want to commit fraud. I don't want to make up a bunch of shit, and I want to just get the deal done, right? And, oh, by the way, it's a better deal for the consumer because they got a partner instead of a lender.
That's true.
Right? If things go bad.
Good point.
Well,
and I love you sharing stuff that is outside the box. And if you guys dig on this, yeah, I'd like to see more reactions and stuff, because that's why we like bringing Bill on. You don't know what you're always going to get, but somebody's always a visionary and looking out there. And you can tell by all the contacts that he has and who he speaks to. And he's created multiple companies, multiple products. He's run multiple companies. He's seen a lot. And that's why we want to bring Bill on. One, he's a good friend. One, he tells you like it is. And I've always appreciated that. Gino and I always we know where we stand with Bill. So moving forward, we have a lot of people right now that are navigating. So we're starting to see more, like a lot of people are hanging in, those refi people, or the ones that are hoping to get a deal here. There are finally, I think another 20 to 30% at least are going away now because they survived till now. They're not going to survive till this refi boom hits. So that's about 20 to 30%, in my opinion, of our competition going away, at least. And then, those of us who are leaning in, and this is, like you said, not quitting. We're going to grit it out, as you said, and we have passion for the business. What do you feel is the best course of action at this point? Because as a leader, you're the one who comes on these calls and tells us, here's what I see and here's what you guys need to be doing to get to the other side. So as the colonel in this industry, what do you suggest for those of us, because you've been around the block? I have my opinions. I share it a lot on these calls because we've been around the block with you and with many great leaders, and we're tied in with every great influencer and leader in this industry through Momentum Builder. But I'd love to get your opinion, because we have people that are dealing with, rocket mortgages and the banks and inflation and rates and competition. How do you feel mindset wise and direction wise? How do we get to the other side, Bill?
Yeah. So let's just, so a great question, probably the one. And I guess that I sort of, I help 5 or 6 different companies, CEOs and different folks today, and they all have different origination plans, different structures and everything else. I say the first thing is you're going to have enough capital to sustain yourself for the slog until it corrects itself, right? So I'm going to say that you're somewhat of a survivalist and you're in the middle of the desert or you're in the forest, and you've got to be able to live and kill and eat, right? And kill what you eat, because there is no, interest rates aren't dropping. Barry Habib, it's not going to happen for a while. This is going to be a long slog. So the first thing is prepare yourself. Get your costs down as low as possible. Don't do anything. It's like wasting time. If you are a survivalist, right, the most important thing is survival. So you're not thinking about the future yet. Our goal is to survive. So we have to make sure that we have, from body heat and water and all those things, you have to be disciplined as you do this. So what I spend time doing is making sure that don't do anything that could hinder your survival, right? So it could be spending money, it could be growing, it could be shrinking, it could be panicking, getting out of this, doing that. So get yourself in a survival mindset, which I think is first and foremost, just this is going to be a while. Okay, once I've got you and slapped you around enough that you're ready to survive, it then becomes, okay, I'm trying to get to 2025. What I think is going to happen is it's somewhere between the now and the election and something else, this crescendo in interest rates are going to go the other way a little bit, right? And at that point, you're going to pick up velocity, and you have to be ready to be able to do that. In the interim, to get from survival to maybe strategy of growth or what we want to do, you have to do what you are best at, whatever that is. And if you're a loan officer, the thing that I do is get the hell out of your office and go meet everybody. That's the only thing you can do, is go see people, right? I don't give a shit if you go to the mall and just start bugging people, right? In fact, I'm sorry, there's probably no malls left, given what's happened. Go to someplace. Okay, let's go to a restaurant, right? But at the end of the day, I want to see realtors, financial planners, accountants, CPAs, insurance people, lawyers, builders, anybody. And like I say, from Chamber of Commerce to anything else, you have to go now to the body and begin to build this group, because out of that, you're going to get a couple of transactions and you're going to survive. You're going to be able to eat until 2025, which is what we want to be able to do. What will help you get there are products, right? And the product has to be products that give income to consumers or higher LTVs. So, and I think on the flip side, get to know equity sharing on the other side, right? Because it'll allow you to pick up a couple percent of the marketplace. And I like it better than a reverse. We've all tried reverse at Finance of America, right? I like reverse, but it's age appropriate. It's got it's HECM driven, right? Got a lot of problems. We are going to be successful in launching products and services that are equity driven right now. And what Don and I talked when we started, right? What is allowing us to survive? The good news is that every investor that I talk to has convinced themselves, as America has, that home prices, HPA, home price appreciation, is flat to going up. And you saw CoreLogic's information today. If you looked at that chart today in the MBA piece and you just took a look at home prices, home prices, every investor in America has to make two decisions. Where do I put money? Because I got plenty of it to invest. And what's the safest asset? Yield is something else, right? Almost all these investors believe that single family loans are the best place to put money other than a treasury. or put it in your money market. And the second thing that they have to convince themselves is that home prices aren't going to deflate. Think about that. And
100%.
most of them thought it was going to deflate. And I've always said,
Mm-hmm.
I mean,
They're waiting for a crash.
There's factors that drive up home prices: consumer confidence, changing government regs like tax credits, deductible interest, depreciation, ADUs, subsidies, low mortgage rate, thriving employment, proximity to a more expensive market, low inventory, natural disasters. All those things drive up prices. The risk factors that cause them to fall are natural disasters, recession, high unemployment, surplus of inventory. And now you've got this other stuff: climate change, and is insurance available, maintenance and utilities, is water going to be, I mean, we got some shit happening in real estate, but at the end of the day, they have all made the decision it's a safe bet and they want to put money in here. So now it's my job with these investors to bring that to you, right? Because and you can't bring it by you guys signing up every company with a different guideline to do one thing. That's the stupidest thing I've ever heard of. So how do we take it? And that's the trick. How do we cannibalize agency, move everybody into non-agency, non-QM, other than government? And I have to help you get your customers on. So I've got to do a 90 no MI to $1.5 million or something, right? I've got to be able to qualify people in different ways, because that's what's going to do another deal for you and get you to survive. You have to survive. Survival is 9/10 in your mind and 1/10 knowing what the fuck to do when you're stuck in the middle of the desert.
Okay, I want to stop right there because, Bill, that was key. And you're a leader, and you've taught Gino and I to be, leaders for our crew, because we have to be the ones. If our mindset's wrong, everybody else is effed, like you said. I mean, literally, if our mindset's not in the right place, and I think everybody that's on our team knows that our mindset's not screwed. We're really focused. We know how to we're going to help everybody survive, because the other side is wonderful. Everybody's going to understand that other side is you make your money in those 1 to 2 years, and then sock it away, and then grind through the next one, and then sock away, because nobody makes money like we do. Doctors don't. We kill it when it's good, as long as we have our share of the market. And right now, only thing we're trying to do right now is, before, when you had some refinance business trickled in and you had a few agents, you can get away with like 3 or 4 agents you like. Now, I'm sorry, you need 50, because none of them have very much business right now. So right now, we're leaning in hard, our entire group. And I suggest anyone out there, if you're going to survive, is leaning in and trying to grab more potential business. You can't survive with 10. When Gina and I were crushing the industry, everybody thought we just knew the top people in our industry. They really did. They thought, well, you guys been in the business for 35 years. You run the company. You know all the top, real estate agents. Bullshit. Who here has worked with the top real estate agents actually made money? You don't. They ask you to pay for everything. They're higher maintenance and all that. We had 50 real estate agents that gave us 1 to 3 deals a year, but that equaled out to be 200 deals a year, because we got a little bit here and there. They're loyal. They don't ask you to pay for much, and you perform for them. You actually perform for them. You take their calls. You show up. You meet with them. You take care of their clients. You close on time. You do that, you're successful. So right now, we're just trying to go out and grab as much, and I know my team hates, because I love this word, is market share. Only way we're going to survive to the other side is grab more market share, whether it's for us as regionals to grab a few more great producers, to grab them more market share, and then help those producers get more of what's available, and crushing our competition. Literally, we're a lot of our competition, unfortunately, and in your negatives, put in the chat if you have people that you see in your markets that are putting their head in the sand and literally waiting for the market to get better, waiting for rates to get better, waiting. Our industry in our area is pretty much doing that. We're like the only ones right now that are like, rah, rah, rah. We're ready to go. We're ready to help you. This is good. It's a good time to buy and sell, as long as you work with us. So we're leaning in pretty hard right now.
I think realtors, yeah, I don't, there's no silver bullet, right? This isn't something that we can solve. It's going to be a longer slog than what you think. It's going to be devastating to the industry, and you have to enjoy that somehow. And the only way to enjoy it is to survive.
I love
That's
it.
it, right? Because there is no, and the only way to survive is just to do the things that you know, be in the presence of the prospect, develop your database and get it bigger, go out and search and find, Ben, I've got to give you product, right? We've got to give you more products that are easier. And so the consumers can say, I mean, the difference at First Franklin or at Own It or in any of those where we had a product is people would say, I can buy a house, no money down. And I know how to go do that, right? And I think what's happening now is in order to do anything, we're sort of stepping our way out of agency into this new world. And we've got to make it easier for originators to do that, because I can't have you go try to find 300 different investors, and every week I've got to sign somebody else up, and then we got to try to roll out the product. And by the time you roll it out, you do one loan. Then you repurchase the loan because you fuck it up. You don't even understand it, right? So it's like, okay, that doesn't work. So I'm going to focus all my efforts on equity sharing coming this way. And then I'm going to blur agency, non-agency, and non-QM into a product so that you can easily say, hey, if I want to go buy $1.5 million house and I want to put 10% down and I have funky income and my credit's sort of marginal, but I want to buy that house and I've got the money and here I am. How do I do that? And
higher risk
it's
equals
got
higher
proper
rate.
margin. It's underwritten well. You know what you're doing because you got to write the contract first. It's got to be done well, right? And you're competing still for a while with cash and cash offers. So I think this is a slower process in order to sort of get us back to what we would say normal. And I told you guys a long time ago, normal is we're not going to have cash offers, right? And somebody's going to say, I have to sell my house before I buy another one.
Right.
Which is normal. A contingent offer is actually normal.
Right.
And when that happens, we will be in 2025 and you would have survived.
There you go. So anybody, please, I want to see a lot of reactions. Let Bill know what you thought of him sharing his thoughts and being here with you. He's a very busy man and a great friend in the industry. In fact, yeah, there you go. Lots of love for Bill. Gino and I have a ton of love for Bill. So does our team. And Bill is always, what's really cool is Bill's a real person, as you can tell. He's somebody that I pick up on the phone. He answers. We talk about the industry. We talk about how we help you. What's really cool is Bill, and we can't think, Bill is an advocate and hardcore behind the Momentum Builder movement because it's for you. He knows more of us need resources. We need ways to survive, ways to get better, ways to help our clients better, how to help our referral partner better. So that's why we created Momentum Builder. And Bill has been nice enough to give us advice. He's part of our think tank. Like Bill has time to do that, but he loves the movement that we're doing because we're trying to help you and create this resource to give you shortcuts and information and not do it alone. Right now, being alone, you're an idiot. I'm sorry. This is way too hard to do on your own right now. So you should be part of this Momentum Builder community. If you're not, make sure you download the Momentum Builder app where you have our Facebook page. It'll be ready probably in a week or so. Be on these weekly calls. Stay tuned. Follow Bill Dallas. He always gives you insights on a regular basis. And Bill's been nice enough. That's our Momentum Builder community. And then we have Momentum Builder 2024. We're already talking about it now because those of you on the call better get your seats because we're going to limit it to only 500 people. Most of these events go to 1,000. We want 500 of the right people at Momentum Builder. This is our 6th year, and it's going to be amazing because it's going to be strategies that no one else is going to have. No fluff, great networking, hang out with your Momentum Builder community. And then Bill's been nice enough for the speakers. He's putting the speakers dinner and top sponsors dinner at his home. How cool is that? It's going to be special. And then we're closing out the event with the party of the year at On the Record right there. It's going to be the best networking party you've ever been at. And we're going to close out the event with that. You've been there.
Cool.
You danced there.
Cool event. I mean, my home now is Vegas. Don and Gino and I and team, and my wife even, we took a look at, I mean, I love the Park MGM. I like where it is. You guys are going to be there during a cool time of year, right? We have our race. We have the road race that's around that time. You're probably getting close to the Super Bowl, probably right. We're close to Super Bowl or after, and we've got all kinds of things happening in Vegas. So I think you'll enjoy it. And this place is really amazing. And it's clean, neat, and tidy right in the middle of town.
All right. Thank you, Bill. And I'm telling you, we already got a lineup of the best speakers. We have a lineup of some of the best execs. Bill Dowd's going to be on our exec panel with Casey Crawford. It's going to be a game-changing event, and it's not an event. It's actually an experience. There's no VIP tickets. It's one ticket because we want everybody to be part of everything. They want to get the full experience and stuff. Next couple of weeks, we have Deborah Bird coming on. You guys know Deborah. She's always awesome. One of the best in the industry that gives you strategies on how to differentiate yourself. Imperative more than ever. And then we have the man that doesn't hold any bar. This guy basically tells you how it is, Mr. Steve Sims. You'll love what he has to tell you and share with you, and he'll hit you right between the eyes. We're always looking. If you guys have suggestions, like great people like Bill, give us your suggestions on who we need to bring on. That'd be really cool. And other than that, Bill, thank you, buddy. Love you, man.
You too, buddy.
You are my bro and my mentor, and thank you for the time, and looking forward to seeing you soon. Oh, we're putting together our think tank in September, by the way. So we're ready for the second half of the year.
Send our shirt somewhere.
There you go. All right, everyone. Thank you for being part of today's show. Make sure you communicate, be part of the community, and share this with friends so we can help more people. Thanks a lot, everyone. Thanks, Bill. Thanks, Sonia. And thanks, everyone who's on the call. Later.